Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Ed Leggett, manager of the Artemis UK Select Fund. Hello, Ed.
Morning.
So over the last year, investors in UK equities have not done too badly. If you manage to avoid the blip post the referendum result, actually equities have come up quite a lot. Year to date, they're up about 8%. I suppose the big question is, how long can this rally continue?
That is a big question, and I think clearly if you look over long term, equities have been a good place to be, and the cash flows that come off companies are valued at a much lower level than other asset classes because there's volatility inherent within them. And as a result, over long term, you pick up those cash flows and generally make better returns out of investing in equities. But clearly, there'll be individual years and time periods where returns aren't so good. I think if we look back over the last year as a UK equity investor, you've benefited significantly from the fall in sterling. And the companies quoted in the UK, the majority of their profits in absolute terms actually come from outside of the UK. So that's been a big tailwind for investors, which has actually meant that the stock market went up post the referendum rather than down.
And that sterling windfall, that sterling boost, how much longer can we expect that to continue? Because if that's what's driving the market, we saw recently and even today with the inflation news, if the pound rises, then of course the FTSE falls.
Indeed, and there's been a very strong correlation, particularly since the referendum result, as it's very much in the news, in investors' focus, and the two are very interlinked. Depending on people's views of the outcome of the Brexit negotiations, will drive people's views of the long-term prospects of the UK economy, which will drive people's views of sterling, which will in turn drive people's views of the prospects for the companies within the stock market relative to each other. So today, in the fund we run, we're actually, pretty neutral versus the market on sterling, i.e. we've got significant positions in domestic companies, which roughly match the index. And I think probably versus most of our peers, that is, quite different. And if I look at sterling today, I think, there's a reasonable chance that certainly on a 1 to 2 year view, there's a bit more clarity that sterling actually strengthens from here. And as we go through the second half of the year, it's going to be very interesting because if you look at the sterling dollar rate, actually having been an enormous tailwind for companies over the first half of the year, the companies that make money in dollars in the second half of this year at current rates is going to be quite a big headwind. And that will change the relative earnings progression of different companies. So if you looked over the last year, if you've been an overseas earning company and you've done nothing in terms of growing your business, when you've translated that back into sterling, it looks like you're growing at 15, 16%, which, everyone gets a bonus at the company. It all looks great. But in reality, your business has made no progress at all. And then as you come through the second half of this year, if you're a big dollar earner, you've suddenly got a 4 or 5% headwind. And so we see the scope for the relative valuations of overseas equities and domestic equities to potentially start to narrow. And it's quite stretched at the moment, given, the uncertainties caused around the referendum. And
you did touch on it there, but I suppose the question is, with so much uncertainty out there, how do you invest as a UK equity manager? You mentioned that having that particular focus on domestically focused stocks. Are there any sectors in particular that lend themselves to this style of investing?
So we've got, some domestic holdings. We've got many, UK quoted stocks that do things overseas in terms of their business. If we look at the UK, clearly the UK domestic holdings, many of them are linked into the UK consumer spending in some form or another, given that's such a big part of the economy today. And for us, that's part of the market where there are big structural changes happening. So how do we, not pick a company that's maybe having problems cyclically because the UK consumer is under a bit more pressure, but also isn't having problems structurally as well? So if we look in the domestic holdings we own, we've principally got positions in financials, so we like life assurance, in particular, big yields, the pressure for individuals to save for their retirement, etc., is driving, we think, quite attractive growth there. We also like house builders. The desire to own a house, the barriers to entry in that industry are going up. We're not particularly bullish on house prices, but the returns are very high, the yields are high. And you can see that in the numbers. If you've seen from the Persimmons, Redrose, etc., they're all reporting very strong progress. So those would be two sectors we like in the UK. Elsewhere in retail, in leisure, it becomes harder. A stock we've been buying recently would be Lookers, a car dealer. Ticks every box of things people think they don't want. Big ticket consumer item. concerns about PCP finance, concerns around diesel, concerns around imports from Europe into the UK. But underlying structurally, we think that market is consolidating quite quickly. It's quite difficult to disintermediate through the internet, as you've got to get your car serviced, which is where they make the majority of their money. And we can buy it today on 7 times earnings, trading around its property value, i.e. the value of the properties is worth the value of the whole company. And pick up a 4% yield, and we think it will be a lot bigger in 5 years' time than it is today. And there's deep value there. The catalyst is potentially harder to see, but where there's value is where there's opportunity.
Ed, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.